There's a number that doesn't exist in any government report, any credit bureau file, any official debt tally anywhere on Earth. Nobody knows exactly how big it is. Not the Federal Reserve, not the credit bureaus, not even the companies issuing it, not with any real precision. And it's not some obscure derivative buried in a Wall Street trading desk. It's sitting in your phone. It's buy now, pay later. And the honest answer to how much of this debt is out there right now is nobody actually knows. Here's the setup. You're checking out online. Sneakers, a couch, a plane ticket, doesn't matter. And right next to the Pay in Full button sits a shinier option, Pay in 4. No interest, they say. No credit check, they say. Split it into 4 easy payments and walk away today. Companies like Klarna, Afterpay, and Affirm built entire empires on that one sentence. It feels less like debt and more like a magic trick. Suddenly, a $200 pair of shoes becomes 4 painless $50 charges, and your brain, which is terrible at long division under pressure, quietly stops thinking of it as a loan at all. But it is a loan. It's just a loan wearing a hoodie instead of a suit. And here's the part that should actually worry you. This loan is functionally invisible. When you take out a mortgage, a car loan, even a regular credit card, it shows up on your credit report. Lenders can see it. They can factor it into whether you can handle more debt. Buy now, pay later mostly doesn't do that. For years, the major credit bureaus didn't have a standardized way to even record these loans, let alone weigh them the way they weigh a credit card balance, which means a person could theoretically be juggling 5, 6, 7 of these plans across 5 different apps at once, and not one lender evaluating them for a new loan would see the full picture. Not the bank, not the landlord running a background check. Nobody. Think about what that actually means. Underwriting, the entire process banks use to decide who can safely take on debt, depends on visibility. It depends on lenders being able to see what you already owe. Buy now, pay later punches a hole straight through that. It's not that these loans are hidden on purpose. It's that the reporting infrastructure simply wasn't built to catch them. And by the time anyone noticed, the volume had already exploded past the point of anyone could easily patch it. So how big did it actually get? In the US alone, buy now, pay later spending has rocketed from a few $billion into the tens of billions annually in just a handful of years. Holiday shopping season alone now routes billions of dollars through these apps, and the growth curve hasn't meaningfully slowed. Adoption skewed young and skewed towards exactly the demographic with the thinnest financial cushion. People already living paycheck to paycheck, using it to smooth over stuff that used to just get put on a credit card or not bought at all. And here's the thing about smoothing something out. It doesn't make the cost disappear. It just moves it a few weeks down the calendar and stacks it quietly on top of whatever's already sitting there. That stacking is where this gets genuinely dangerous, because nothing stops a person from opening a Pay in 4 plan on one app for groceries, another on a different app for a phone case, a third for a plane ticket, all in the same week. Each individual plan looks small and harmless, $50 here, $30 there, but add them up across 5 apps and suddenly someone owes several $100s in payments due in the next 14 days. And there was no single moment where any lender, or honestly the person themselves, sat down and saw the whole number at once. Researchers have a name for this. They call it loan stacking, and it is exactly the kind of blind spot that traditional underwriting was built to prevent and that this entire industry was built without accounting for. Surveys have started to catch glimpses of how common this actually is. A meaningful share of buy now, pay later users admit to having multiple active plans running at the same time, and a smaller but very real slice admit to missing at least one payment in the past year. Those numbers sound small until you remember they're describing a debt category that mostly doesn't show up anywhere lenders can see it, which means the actual scale of missed payments and overextension is almost certainly larger than any survey can capture, simply because the data infrastructure to measure it properly doesn't fully exist yet. And then there's the fee structure, which sounds harmless right up until you miss a payment. No interest is true technically as long as you pay on time. Miss one installment, and you're often looking at a flat late fee that, expressed as an annualized percentage rate, would make a credit card blush. Multiply a few late fees across a few missed payments across a few stacked plans, and what started as an interest-free convenience quietly becomes one of the more expensive ways to have borrowed that money in the first place. Now, the industry's defense sounds reasonable enough on the surface. These are small, short-term loans, they'll tell you. Low dollar amounts, low individual risk, not exactly a subprime mortgage. And sure, no single buy now, pay later loan is going to bring down the financial system on its own. But that's also exactly the wrong way to measure the risk. The danger was never in any one loan. It's in the fact that an entire category of consumer debt scaled into the tens of billions of dollars while remaining almost completely outside the infrastructure built to track household debt. Regulators, including the Consumer Peace and Financial Protection Bureau, have flagged this gap directly, warning that the lack of standardized reporting means nobody, including the regulators themselves, has a truly reliable real-time picture of how much of this debt exists or how stressed the people holding it actually are. And that's the uncomfortable position we're actually in. The credit bureaus are only just starting to figure out how to fold this data in, building new frameworks to capture pay and for activity the way they've captured every other kind of consumer debt for decades. But building that infrastructure takes years, and the debt isn't waiting around for the paperwork to catch up. The companies issuing the loans have far more visibility into your stacking behavior than any bank, any credit bureau, or you, standing there checking out at 11 p.m. deciding whether 4 easy payments is really such a big deal. Here's the pattern worth remembering. Financial risk doesn't usually announce itself with a 5-alarm siren. It shows up looking convenient. It shows up looking like it's helping. Buy now, pay later genuinely does help some people manage cash flow better than a high-interest credit card would have. That part is real. But convenience and invisibility are not the same thing as safety. And right now, one of the fastest growing categories of consumer debt in the country is running largely on an honor system, with no central place where anyone, including the people carrying it, can actually see the total. Maybe the industry gets its act together and standardized reporting closes the gap before it becomes a genuine problem. Or maybe we look back at exactly this moment in a few years the same way we look back at other financial products that grew explosively while nobody was quite watching closely enough. Either way, the numbers out there right now, split into 4 easy payments sitting quietly across a dozen different apps, and not one institution on earth can tell you exactly what it adds up to.